Welcome back to the deep dive. All right, we've got a mountain of research in front of us. Forensic financial reports, strategy papers, deep dives into consumer psychology, and it's all focused on one company that is, frankly, one of the biggest enigmas on the market today. Costco, ticker COST.
It really is an anomaly, and I think the goal for us today is to try and resolve what looks like a massive financial paradox.
A paradox? How so?
Well, on one hand, you have a business machine that legendary investors, think Charlie Munger, revered for its perfection. It has this incredibly deep moat. But on the other hand, the market is pricing it like a high-growth tech startup, not a retailer that sells pallets of paper towels.
Okay, so that's our mission today. We need to go way beyond the simple retail metrics, the usual sales growth numbers. We're going to use these sources to really get under the hood and understand that tension.
Exactly.
Why is Costco seen as a platinum quality compounder from that Munger perspective? But at the same time, it's trading at a price that a value investor, say a Seth Klarman, would look at and probably call distressed or speculative.
It's the ultimate battle of quality versus price. We're going to dissect a business that is, for all intents and purposes, built for flawlessness. The problem is, its stock price demands that same flawless execution for, the next decade?
A high bar.
A very high bar. So if we can unpack its financial architecture and, really get into the psychological engineering behind it, I think we can show you exactly why that risk-reward equation looks so lopsided right now.
Okay, let's unpack this. We're starting at the very foundation, the philosophy. Because Costco, from what I'm reading here, it seems to have fundamentally inverted the logic of capitalism as we know it.
It did.
So, Section 1, the philosophical architecture of a retail anomaly.
Right. So think about it. When you walk into almost any store, 99% of them, the model is adversarial.
What do you mean by adversarial?
The relationship between the store and you, the customer, it's all built around maximizing their margin. The merchant's one and only goal is to make the spread between their cost and the price you pay as wide as humanly possible.
That's just business, right?
Yeah, that's the traditional model, yes.
I like it.
And it's the model Costco just completely rejected. Their whole philosophical architecture is different. They don't operate as a merchant trying to sell you something. They see themselves as a fiduciary purchasing agent acting on your behalf.
So their goal isn't to see how high they can price a TV.
No, it's the opposite. Their internal goal, their mission, is to figure out how low they can possibly price that TV and still cover their operating costs.
And this isn't just some, marketing slogan on a poster in the break room. It's actually built into their financial DNA.
That's the critical point the sources all hammer home. They have a mandated internal cap on their gross margins. It's not a suggestion, it's a rule.
And the numbers are specific.
Very specific. For any brand name goods, think Sony TVs or Heinz ketchup, the gross margin is capped at 14%. For their own private label, Kirkland's Signature, which is a massive business in itself, they allow themselves a little more room, up to 15%. This is a strategic choice, a self-imposed constraint.
Okay, I have to stop you there because that just seems counterintuitive. If your whole goal is to make a profit, why 14%? Why not 16 or 18? 2 percentage points on their scale would be, hundreds of millions of dollars in pure profit? Why are they leaving that on the table?
Because leaving that money on the table is the strategy. That's what builds and deepens the moat. The moment they start squeezing that margin up to 16, 17%, you, the customer, you start to notice. The price gap between them and everyone else shrinks, and that hard-won trust begins to erode.
So the discipline to stick to that cap is actually their reinvestment. They're pouring potential profit back into the customer experience, into the price.
Precisely. And this idea, this concept of giving away your scale savings directly to the customer, this is what the legendary investor Nick Sleep built his entire thesis around. He called it scale economy shared.
Right. The bigger you get, the cheaper things you get for your customer, not just more profitable for you.
Exactly. Think about the immense purchasing power Costco has. They're buying more of almost anything than anyone else. Instead of hoarding those savings to boost their own bottom line, they systematically pass them back to the consumer through lower prices.
And that creates a flywheel.
A perfect reciprocal flywheel. Lower prices build loyalty. Loyalty drives more volume and more members, which in turn gives them even greater purchasing power to negotiate even lower costs. And on it goes.
So the consumer surplus they create, the actual dollars you save on your grocery bill, that becomes this trust moat. It's an asset that is almost impossible for a competitor to replicate.
How could they? Imagine a competitor trying to suddenly cap their margins at 14%.
It would completely gut their business. Their shareholders would revolt.
They'd have to destroy their legacy business model to compete. So yeah, the forensic conclusion is that Costco has built an asset based on psychology and trust, not just on price. You just know implicitly when you walk in there that if they're stocking it, it's probably the best value you're going to find.
Which leads right into the next point, which I think is the most critical for anyone trying to analyze this company.
Right. Costco isn't really in the business of selling goods.
They're selling a subscription.
They are selling a subscription to an incredibly efficient supply chain. The goods, the hot dogs, the giant teddy bears.
Yeah.
They're just the mechanism to get you to renew.
And the financial architecture, I mean, it really flips the whole script. Let's look at those numbers you flagged for me.
Yeah, so if you just look at the top line revenue, merchandise sales are, almost everything, over 98%. The membership fees, that subscription income, it looks like a tiny sliver, only about 1.93% of total revenue.
A rounding error, basically. But that's not the real story.
Not at all, because that merchandise revenue has huge costs attached to it, right? You have the cost of the goods themselves, shipping, labor, keeping the lights on.
All that.
Exactly. So when you slide down the income statement to operating income, the picture completely inverts. Those tiny membership fees suddenly account for a staggering 52 to 70% of the company's entire operating profit.
Wait, say that again? Up to 70%?
Up to 70%, yeah, depending on how you decide to allocate some of the general and admin expenses. But the point is, it's the majority, the vast majority.
So what you're saying is, if the entire merchandise side of the business, all the warehouses, all the products, just broke even, or even ran at a small loss,
the company would still be massively profitable just from those $60 and $120 a year subscription fees alone.
that's incredible. The entire retail operation is basically a break-even logistics service.
It's a marketing service. Its sole purpose is to uphold that low price promise to a degree that makes renewing your membership an absolute no-brainer.
So for our analysis, the standard retail metrics like same-store sales are secondary.
They're important, but they're not the main thing. The true non-negotiable health indicator for this organism is the renewal rate.
And that number is?
It's consistently pushing 93% globally. And in their core markets, the US and Canada, it's in the high 90s. If you ever see that number start to dip, even a little, that's when you know the entire model is in trouble.
It's the ultimate canary in the coal mine for them. They basically weaponized the idea of a loss leader, but they turned it into a high-margin recurring revenue subscription service.
That's genius.
So, okay, we get the philosophy. This moat of trust is powerful. But trust alone doesn't fend off the biggest companies in the world. How does Costco strategically defend its turf against, the two titans of retail, Walmart and Amazon?
This is where we get into the concept of counter-positioning. It's a beautiful strategic idea. It means you adopt a business model that's not just different, but superior in a way that the big entrenched incumbents simply cannot copy.
Why can't they copy it?
Because it would require them to damage their existing highly profitable businesses. It's a form of competitive jujitsu.
Okay, let's break that down. Let's start with the Walmart constraint. Walmart is huge, they're efficient, they have incredible logistics. Why can't they just launch a competing warehouse club that matches Costco on price?
Because Walmart is fundamentally trapped by its own success, by its customers' expectations. Their whole model, the Supercenter, is built on the promise of endless selection.
Right, you go there for everything.
Everything. A typical Walmart stocks, 140,000 different items or SKUs, toys, car parts, groceries, clothes, everything. Costco, in stark contrast, is all about intense curation. They only stock about 4,000 SKUs.
So if Walmart tried to compete head-to-head with Costco, they'd have to drastically slash their selection and cap their margins at that 14% level.
And in doing so, they would be destroying the very foundation of their brand. Their core customer who goes there for that one-stop variety would be alienated. And capping their margins across the board would decimate the profitability they get from higher margin stuff like apparel and electronics.
So Costco's limited selection is actually a strength that Walmart can't mimic without essentially committing corporate suicide.
Exactly. It's self-harm. Now, what about the other giant, Amazon?
Right. Amazon has infinite money, and they dominate convenience. They're obsessed with efficiency. What's stopping them?
Amazon runs headfirst into a wall called the logistics physics problem.
The logistics physics problem, explain that.
E-commerce, for all its wonders, has really, really bad unit economics when it comes to things that are heavy, bulky, or cheap. Think about shipping a 40-pound bag of dog food, or a 30-pack of paper towels, or a case of bottled water.
The shipping cost would be more than the item itself.
It often is that last mile cost, the actual expense of getting that heavy thing from a warehouse onto a truck and onto your specific doorstep. It just destroys any potential profit margin.
And Costco, they just sidestep that problem entirely.
They sidestep it brilliantly. They've effectively outsourced the most expensive, most complicated part of the logistics chain, that last mile to you, the customer.
We're providing free labor.
You are. You willingly drive your own car, you push the cart, you pick the items, you load them up, and you haul them home. You provide the free labor and the free transport, and in exchange, Costco gives you a massive price arbitrage.
So it's this great bifurcation of retail. Amazon wins on convenience and that endless aisle. Costco wins on curated quality and extreme value per unit.
They occupy slightly different orbits. They can coexist because they're solving different problems for the consumer.
Here's where it gets really interesting funny, though. It's not just about the logistics, it's the psychology. They somehow managed to turn a mundane chore, stocking up on toilet paper, into a treasure hunt.
This is their merchandising secret weapon. It's all about using scarcity and the dopamine rush of discovery. They strategically and constantly rotate about 25% of their inventory.
The so-called wow products.
Exactly. You walk in one week and there's a $10,000 diamond ring next to the asparagus, or a case of super high-end Bordeaux wine. The next week, it's gone. And in its place are gold bars, or a fancy kayak, or a giant wheel of Parmesan cheese.
I remember seeing this once. They were selling this massive industrial-grade safe. And I'm thinking, who is buying an industrial safe at Costco? But because it was there and it was a great deal, people were looking at it. That fear of missing out, that FOMO, it has to have a real financial purpose.
Oh, it has two very critical forensic purposes. First, it increases frequency. You might not need paper towels this week, but you go to the warehouse anyway. Why? Because you're afraid you might miss out on that limited time kayak or that discounted TV. That compulsion dramatically drives up what's called their share of wallet.
And we actually saw the data on this from fiscal year 2024.
We did. The data is clear. This strategy is the lifeblood of the model. Traffic, just the number of people walking in the door, increased by a huge 6.4% worldwide in 2024.
And they need that constant traffic.
They absolutely need it. It's essential to offset their massive fixed costs. I mean, running those huge refrigerated warehouses isn't cheap. And to pay for their famously high employee wages, which are way above the retail average.
Okay, so that's the first purpose. Get people in the door more often. What's the second?
The second is that it speeds up the cash conversion cycle, which we're going to dive into in a bit. But the short version is urgency makes people buy faster. If you see a high-ticket item, a discretionary purchase, and you know it's a one-time deal, you buy it now. You don't go home and compare prices online for 3 weeks.
Right, you just pull the trigger.
You pull the trigger, and that velocity, that speed, dramatically improves the rate at which Costco converts its inventory into cash. They're basically leveraging your impulsiveness to make their balance sheet stronger.
That philosophical framework is compelling, but does it actually show up on the ledger? Let's switch gears to Section 3 and see if the accounting really backs up the philosophy. When we're looking at a company this big, the first step is always to check the quality of the earnings.
It's essential, especially for a stock trading at this kind of multiple. So the reported net income for fiscal year 2025 was a very healthy $8.099 billion. But a proper forensic analysis means we have to adjust that number. We have to strip out some non-recurring tax benefits that, artificially inflated that headline figure.
Okay, what were the specific adjustments we need to be aware of?
We found two big ones. First, in the fourth quarter of 2024, they booked a $63 million tax benefit that wasn't operational. It was related to something called a transfer pricing settlement.
That sounds complicated.
It is, but all you need to know is it's a one-off accounting thing between their international divisions. It's not repeatable income from the core business.
Okay, so that's $63 million. What was the second adjustment?
In the first quarter of 2025, there was another one, a $100 million tax benefit. This one came from deductions related to employees exercising their stock-based compensation.
So again, real cash savings for the company, but not from selling more rotisserie chickens.
Exactly. It doesn't reflect the core, repeatable earning power of the business. So when you strip out these, below-the-line tax items,
What happens to the growth rate?
the result is a slightly lower but much cleaner estimate of their true earnings. And more importantly, the organic growth rate for that year drops from the reported 9.9%, which is a really attractive near double-digit headline number,
Yeah.
down to a still very strong but noticeably slower rate of about 7.8%.
So the core business is still growing at a great clip.
Right.
But if you're an investor paying a 48 times multiple for this stock, the difference between 9.9% growth and 7.8% growth compounded over a decade is absolutely massive. It creates this subtle but very real gap between the story and the reality.
It's all about managing expectations. The machine is humming along beautifully, but the investment thesis demands we know exactly where that growth is coming from.
Now, let's look at a metric that for any other company we'd analyze completely differently. Gross margin discipline.
Yes, this is so counterintuitive, but it's where you see their commitment to the philosophy in black and white. For fiscal 2025, their gross margin was about 12.8%.
And if I were looking at, I don't know, any other retailer, I'd be asking, why aren't you expanding that margin?
Yeah.
Especially with all the inflation we've seen. Consumers are used to prices going up.
And that would be the novice mistake here. For Costco, seeing that margin expand, say moving from 12.8 up to 15%, that would be a 5-alarm fire, a huge red flag.
A red flag. Wow.
Yeah, because it would signal that they're drifting from their strategy. It would mean management is getting greedy or complacent, that they're pushing prices higher and abandoning that scale economy's shared promise.
So the discipline to keep margins flat or even let them compress a little during high inflation is actually the strongest possible sign that they're sticking to the plan.
It's proof. It proves they're prioritizing customer trust and those long-term renewal rates over any short-term profit boost. The margin is optimized for loyalty, not for profit. That razor-thin margin is what they pay to acquire and keep the best customer base in all of retail.
All right, let's move from the income statement over to the balance sheet, because this is where all that operational efficiency really translates into raw financial power.
Yeah, this is where you see the structural strength of the whole enterprise.
And the absolute centerpiece of this is the anomaly known as the cash conversion cycle, or CCC.
Right, so the CCC, it basically measures how fast a company can turn its investment in inventory into actual cash from sales.
Yeah.
For most companies, this number is positive. You have to spend money on inventory, wait to sell it, and then wait for the customer to pay you.
Which means your cash is tied up. You often have to borrow money just to finance your own inventory.
Exactly. But Costco, along with a few other elite retailers, operates with a negative or near zero cash conversion cycle.
Which means they sell their inventory and collect the cash before they even have to pay their suppliers for it.
Precisely. Let's just walk through the numbers quickly because it's pretty amazing. First is days inventory outstanding, or DIO. That's how long stuff sits on the shelf.
What?
For Costco, it's about 28 days. Very fast.
Then you have days sales outstanding, DSO. How long to get the cash from the customer?
Which is almost instant, right? You pay with cash or a credit card. So that's only about 4 days.
Okay, and here's the magic lever. Days payables outstanding, DPO. How long they take to pay their suppliers.
And thanks to their massive scale, they can stretch that out to about 30 days. So you run the math. 28 days for inventory, plus 4 days to collect, minus the 30 days they get to pay their bills.
You get a CCC of about 2 days. And you said in some cases it even goes negative.
It can dip down to -9 days, depending on the timing. But whether it's 2 or -9, the implication is the same. Costco's suppliers are effectively giving them an interest-free loan to finance their inventory. This float is a massive hidden form of leverage.
Give me an analogy for that. Why is that such a superpower?
Okay, imagine you went grocery shopping today. You get the food, you take it home. But your credit card isn't actually charged until next month. And then tomorrow, someone pays you for those groceries.
So I'm holding their money for a month for free.
You're holding free third-party cash. That's the float. That's Costco's superpower. It gives them the capital to expand, to build new warehouses, to enter new countries, all without having to take on expensive debt or dilute their shareholders by issuing new stock.
And speaking of debt, their overall balance sheet, as of the end of August 2025, it really is a fortress. It looks more like a conservative utility company than a retailer.
It's anomalous. I mean, the company's sitting on $14.16 billion in cash and cash equivalents, a huge pile of cash.
But against that,
They have only $5.71 billion in long-term debt, so they have a net cash position of over $8 billion. Their cash on hand is almost 3 times bigger than their long-term debt.
that gives them ultimate flexibility. They can weather any economic storm. They can pay those huge special dividends we'll talk about.
And it's not even the biggest hidden asset. The true hidden value, the one that doesn't fully show up on the balance sheet, is their real estate. Unlike so many competitors who lease their stores, which can make their numbers look good in the short term, Costco owns the vast majority, about 80% of its warehouses.
And accounting rules mean that property is on the books at its historical cost, not its current market value.
Exactly. So the net book value is recorded at around $32 billion. But for a warehouse they bought 20 years ago in a now booming suburban area, the fair market value of that land and building is vastly higher. It creates this massive hidden inflation hedge. While their competitors face rising lease payments every year, Costco's occupancy costs are basically fixed.
Let's tie this all together with free cash flow. The reported FCF for FY 2025 was $7.84 billion. But you make a key distinction between reported FCF and what you call structural FCF.
This is a vital distinction if you want to value the company for the long term. You need to strip out the spending on growth to see the true cash-generating power of the existing machine. So total capital expenditures, or CapEx, was high in 2025, about $4.7 billion.
Okay, and if we use depreciation, which was about $2.4 billion, as a rough proxy for just maintenance spending, the money needed to keep the existing stores running.
Then we can estimate that the difference, about $2.27 billion, was all investment in growth, new stores, new logistics centers.
Right.
And that lets us calculate the structural FCF. That's the cash the business would spit out if management just decided to stop growing and milk the existing assets. And that number is huge. It's approximately $10.1 billion.
So that $2.27 billion difference is really significant. It shows the company is actively under-earning its potential cash flow because it's reinvesting so heavily. For a long-term investor, that's incredibly bullish, assuming, of course, that the return on that new investment stays high.
That's the key assumption.
All right, we've established that Costco is a structural masterpiece, a platinum quality business. Now we have to confront the elephant in the room, the price. As the great value investor Seth Klarman always said, no asset is so good that it can't be overpriced.
And this is where the cold, hard math just forces you to pump the brakes. Costco is currently trading at a trailing P/E ratio of about 48.7.
48.7 times earnings.
It's an extreme premium. It really forces you to ask some profound questions about what the market is thinking.
So let's put that number in context. How does it stack up against its peers or the market as a whole?
Well, the S&P 500 is trading at about 24 times earnings, so it's more than double the market average. Their biggest rival, Walmart, is at 42 times, which is already seen as historically expensive. But then you look at other competitors. Target is trading at a normal 16 times earnings. BJ's Wholesale is at about 21.
So Costco's valuation suggests it's not even in the same category. It's like it's detached from the laws of retail gravity.
And the PEG ratio, which divides that PE by the expected growth rate, it tells an even crazier story.
What's that look like?
Costco's PEG ratio is almost 5. Historically, a PEG ratio over 1 is considered a bit pricey. A ratio of 5 is what you'd expect to see from a hyper-growth tech monopoly that's inventing a new industry, not a mature retailer. The market is essentially saying Costco's earnings are safer than a U.S. Treasury bond and that they're going to grow at a phenomenal rate.
But wait, if the business really is platinum quality, shouldn't it get a premium? Isn't that the whole point of having a durable moat? Shouldn't its earnings be worth more than a generic company's?
That is the bull case, and it's partially true. Quality deserves a premium. The question is how much of a premium? And that leads us to the most dangerous part of this whole valuation story. The equity risk premium inversion.
Okay, break that down for us.
So if we look at the big picture of the capital markets right now, this becomes really concerning. As of December 2025, the 10-year U.S. Treasury yield, that's our risk-free rate, is 4.14%. That's the return you get, guaranteed, for just parking your money with the U.S. government.
Okay, 4.14% risk-free. Now, what's Costco's earnings yield, the return you get on your investment today?
The earnings yield is just the inverse of the PE ratio. So 1 divided by 48.7, that gives you a yield of 2.05%.
Okay.
Now, you calculate the equity risk premium by subtracting that earnings yield from the risk-free rate. So 4.14% minus 2.05%.
That gives you a negative number, negative 2.09%.
It's a financial contradiction. It means you, the investor, are accepting a negative carry to own this stock. You are paying a premium to own a risky asset that currently yields less than the safest asset on Earth.
So you're betting entirely on future growth to make up for that.
Entirely. The market has priced out any possibility of things going even slightly wrong. Mathematically, it's pure speculation at this price.
This feels like a feature of the current market, this scramble for anything that looks like quality and safety. By the way, for anyone listening who wants to track the overall market temperature and see if these kinds of premiums are normal, you might want to check out the Buffett Indicator app. It's a pretty neat tool that gives you a daily read on whether the total market is looking frothy or undervalued relative to GDP. It's great for putting an extreme valuation like Costco's into a broader context.
That's a great point, because this price is a symptom of a broader market condition. And to quantify just how much optimism is baked into this price, we can run a reverse DCF, a reverse discounted cash flow analysis.
So instead of trying to find the value, we start with the price and work backwards to see what growth rate is implied.
Exactly. To justify today's share price of around $888, what rate of free cash flow growth does the market need for the next 10 years?
Let's hear it.
Assuming a conservative cost of capital of about 8% and a long-term terminal growth rate of 3%, the math suggests the market is pricing in 12 to 14% annual FCF growth for the next 10 straight years.
12 to 14%. That's basically demanding that they maintain their peak pandemic-era growth rates forever. Their historical 5-year revenue growth is around 11%, so the market is demanding they actually accelerate from an already high base.
And that creates a huge asymmetry in the risk-reward. What happens if growth just slows down to a more normal but still excellent rate of, say, 7 or 8%?
The stock would have to re-rate.
It would have to. If the multiple just compressed from 48 down to a still very premium 30 times earnings, that implies a stock price of around $550.
That's a nearly 40% drop. And not because the company did anything wrong, just because the valuation came back to earth. The machine is perfect, but the prices run way, way ahead of the fundamentals.
The downside risk here from the valuation is just immense.
All right, let's use Charlie Munger's favorite tool. Invert. Always invert. Instead of just admiring how great Costco is, let's ask, what could actually go wrong? What could kill this organism? Or at least what could trigger that multiple compression we just talked about?
The first and maybe most subtle risk is an internal one. It's this idea of a demographic cliff and shrinking basket sizes.
What's the data show?
The data shows that about half of all new members signing up are now under the age of 40, millennials and Gen Z. On one hand, that's great for the future, but in the short term, it's a headwind.
A headwind. Why? You'd think getting younger customers is always a good thing.
Because younger people generally have less spending power, and more importantly, they have less storage space. They tend to live in smaller, more urban homes. So that core Costco value proposition and buying huge bulk quantities is just less compelling.
So traffic is going up. We saw that 6.4% number, but the average amount spent per trip, the basket size, might be flattening or even going down.
Exactly. And that puts pressure on the single most important metric for warehouse profitability, which is sales per square foot. To keep these younger, more digitally native members happy, Costco is also having to lean more into things like Instacart delivery, which adds a layer of cost and complexity that hurts their beautiful, simple unit economics.
Okay, so that's a demographic headwind. What about market saturation? I mean, they have 630 warehouses in the U.S. alone, and almost a quarter of them are just in California. How much more room is there to grow?
This is the cannibalization effect. It's a real and unavoidable drag on growth. Increasingly, their new store openings are happening inside the trade areas of their existing successful stores.
Management says this is just to relieve overcrowding.
That's the public rationale, and there's some truth to it, but mathematically, it's a direct headwind to same-store sales growth for the older locations. If your valuation demands 12 to 14% growth, cannibalization is a force pushing you back down towards that 7 or 8% reality.
Which means the whole growth story becomes heavily reliant on international expansion.
And while that's promising, it's not a slam dunk. The club model is built on American habits: big cars, big suburban homes, a culture of stockpiling. Trying to transplant that model to dense European cities or Asian markets with different shopping habits is, well, it's just not guaranteed to scale with the same velocity.
Let's talk about some of the yellow flags that forensic investors look for. What are the insiders, the management team, doing with their own money?
The trend here is pretty clear, and it's not bullish. The data shows that company executives have been net sellers of the stock for 8 straight quarters.
Quarters?
Yes. Key executives, including the new CEO, Ron Vakras, who sold over $12 million worth, and the CFO, Gary Millerchip, they have been consistent, significant sellers.
Okay, but the counter-argument is always that executives sell for all sorts of reasons. Taxes, diversification.
And that's true. But what's more telling here is the complete absence of any open market buying at these prices. The people who know this business better than anyone on earth are choosing to take money off the table, not put more on. It's a quiet signal of caution.
It lines up perfectly with the priced for perfection thesis. They know how great the business is, but they also seem to know the stock price is prohibitive.
Exactly. And finally, let's talk about the biggest macro risk. The one geopolitical threat that could shatter their entire model: tariffs.
Costco is a massive global importer. So the threat of a universal 10 or 20% tariff, something that gets talked about a lot in political cycles, that's an existential threat to their whole philosophy.
It is. If tariffs suddenly raise their cost of goods by, say, 10%, Costco is stuck between a rock and a hard place because of that strict 14% margin cap.
They have two impossible choices. Choice one, pass that 10% cost increase directly to the consumer.
Which violates their sacred low price pledge. It narrows the value gap, it hurts trust, and it could damage renewal rates. It attacks the very foundation of the moat.
Okay, so choice two, they absorb the 10% cost themselves.
They can't. Their merchandise margins are already razor thin, only around 12 or 13%. A 10% cost increase would wipe out their merchandise profit entirely, maybe even push it into the red. The whole business would become totally dependent on membership fees just to survive. It's a massive, unhedgeable political risk.
All right, before we get to our final verdict, let's quickly look at how management uses all the cash this machine generates. Capital allocation, starting with that membership fee hike we saw in September 2024.
Yeah, it was a modest increase, $5 more for Gold Star, $10 more for executive members.
So how does a small change like that flow through the financials, and what does it mean for a stock that's already priced for the moon?
Well, with their huge membership base, analysts figure this adds about $290 million to operating income over the next couple of years. But the key here is that unlike revenue from selling merchandise, this fee hike revenue flows 100% to the bottom line, pre-tax. There's no cost of goods sold.
It's pure, high-octane profit, a direct injection into earnings.
Correct. But it functions as a one-time step function increase. The market, being a forward-looking machine, has already fully anticipated and priced this in. So once this catalyst is fully cycled through, the company goes right back to its underlying organic growth rate, which we've established is probably closer to that 7 to 8% range.
The market has already drunk the juice from that catalyst.
Absolutely. And that brings us to their very unique capital return policy. They prefer these big, one-off special dividends over consistent share buybacks. They paid a massive $15 per share special dividend in 2024.
And they've done this multiple times before.
Multiple times. 2020, 2017, 2015, 2012. It's part of their playbook. And from a forensic standpoint, it's a sign of incredible discipline.
Why is it superior to just buying back their own stock, which is what most companies do?
Because the stock is trading at nearly 50 times earnings. Management is implicitly acknowledging that buying back their own stock at such a high multiple would actually destroy shareholder value. They're signaling that they think their own equity is overpriced.
So by paying a special dividend, they're giving the excess cash directly back to shareholders instead of overpaying for their own shares.
It's a subtle but powerful admission that the stock is overvalued, but they're still committed to being prudent with shareholder capital. It's management telling you the business is a gusher, but the stock price is too high for us to be buyers here.
So what does this all mean? We've done the deep dive, we've looked at the reports, and the conclusion feels dual. There's this fundamental conflict between the quality of the business and the price of the investment.
That's it, exactly. The verdict on quality, from a Mungo perspective, is undeniable. It's platinum. The trust moat from the scale economy shared model is deep, it's getting deeper, and it's almost impossible for anyone to attack. The balance sheet is a fortress. The business machine is perfect.
The verdict on valuation, from a Klarman perspective, is just as clear. It's distressed or speculative. The price demands absolute perfection. It accepts a negative risk premium. It bakes in a decade of growth that looks mathematically heroic. There is simply no margin of safety for anyone putting new money to work at today's price.
The machine is perfect. The price is a high-wire act without a net. The asymmetry is just too great. A prudent investor, based on this work, has to wait. You can't pay a speculative price, even for a platinum asset.
Absolutely. The rational move, based on everything we've seen, is to wait for the inevitable mean reversion in that multiple, a pullback to a more reasonable 30 to 35 times PE range. That would put the stock somewhere around the $600 level. And history shows these pullbacks do happen whenever the market gets nervous or the growth story hits a speed bump.
Which leads us to our final provocative thought for you to take away and consider. We know the machine is built to last. But what specific systemic shock could be big enough to trigger that necessary multiple compression? Would it be a long, deep recession that finally crimps consumer spending? Or could it be a technological breakthrough from Amazon that finally solves that logistics physics problem for bulk goods? Think about what external force could be powerful enough to temporarily disrupt this perfect narrative and bring this incredible company back down to a price where it's actually a great investment.